Welcome back to the show, everyone. Joining me this week is Daniel Lacalle. He is the chief economist at Tressis. He's someone I've been following for some macro perspective that I think has been really brilliant. So, Daniel, thanks so much for joining me on this show.
Thank you so much. I'm very glad to be here. So thank you very much for inviting me.
All right, well, let's start with the Fed cut because that was a really big event that's happened over the last few months. And I think the size of the cut really caught some people off guard. We had 50 basis points, but also the timing. We have stocks at all-time highs. The labor market's been relatively strong. And here the Fed is coming in to preemptively cut rates. And I heard you describe this as a government bailout. So can you elaborate on that?
Yes, to start with, we have to go back a little bit. No, in June, the Fed started panicking when the Treasury yields started to rocket, and we saw the 2-year bond yield going through the roof. And the Fed decided then to delay the normalization of the balance sheet. Delaying the normalization of the balance sheet, for everyone that's watching and listening, is basically printing more money. No, so that was the first sign of panicking. But the real sign of panic came in September when they decided to cut rates by 50 basis points, despite persistent inflation above the target, core inflation well above the Fed's target, and the labor market figures and the GDP figures being relatively robust. In fact, the messages provided by Mr. Powell were completely inconsistent. On the one hand, he was saying that there were no signs whatsoever of recession, even of a downturn. Financial conditions were at the looser level seen in years, and they decided to cut rates by 50 basis points. So what I say is that it's bailing out the Treasury, because at the same time, what was happening was that global demand for treasuries was declining. No? And that the government continued to issue more and more debt. Deficit spending went to a new 2 trillion figure, and the Fed basically was trying to reduce the pressure on the yield of the sovereign debt. Couple of weeks later, it all came back to a halt, because basically the market real rates started to push yields back up again, and obviously led them to new highs, to the July 31 levels. No, so that's basically what it was doing. The Fed basically, there was no reason to cut rates. The only logical reason to cut rates was to try to disguise the insolvency problems of the government and the Treasury's completely insane increase in deficit spending and debt.
Right. So what I hear you saying is this really all comes down to government debt. Yet we still have politicians spending money like crazy. We're running these multi-trillion-dollar deficits, and really neither of the presidential candidates seem to want to talk about the debt elephant in the room. I don't know if you agree with that, but when they do talk about it, one thing you often hear is, "Oh, we'll raise taxes to pay for the different programs. We'll tax the rich." And I've heard you say that high taxes are not actually a tool to reduce high debt. So why don't you explain that?
Yeah, well, high taxes are not a tool to reduce high debt. High taxes are a tool to maintain elevated levels of debt. If you look at countries with high levels of taxation, they don't have low debt. They have high levels of debt. France, the Euro area, Japan. So it works this way, You spend a lot, and the government says, okay, we're going to deficit spend whatever, and then we're going to raise taxes. They raise taxes, revenues don't increase as much as they expected, so the deficit continues to be elevated, and then they raise taxes again. But basically, when they go to rating agencies and to investors, they say, oh, don't worry about our levels of debt, because we're raising taxes. And obviously they come with the message of, we're going to just raise taxes to the wealthy and to corporations. And then citizens suddenly find out that they have become wealthy in the eyes of the government. So it's basically, so the problem of the election is very, very significant, because I think it's the first election in which none of the candidates is directly talking about what measures they're going to undertake in order to reduce debt and reduce the deficit. In fact, Kamala Harris says that her deficit spending plan, which is adding to the current deficit, is going to be paid by itself because it's going to generate higher levels of growth. But that doesn't even address the current deficit, if you actually believe that, which is obviously impossible to believe. It doesn't even address the current deficit and the current levels of debt. No, in the case of Trump, Trump's campaign has found a roundabout way of talking about cutting spending, which is we're going to defend the purchasing power of the U.S. dollar. Which, if you really start to unravel that enigma, it's basically we're going to cut spending and we're going to reduce the deficit. But they're also announcing a very large tax cut, which can also add to the deficit. No, so it's a big problem because in the Treasury's own estimates, you have that they are assuming that without a recession, without an employment contraction, and without any type of revenue contraction, the level of debt is going to increase by 16 trillion in the next 10 years.
Right. I mean, those charts from the Congressional Budget Office, seeing the projections, they're just wild. And really, the biggest problem when debt gets this high is every new dollar generates less and less GDP growth, right? So, can you break that concept down for the audience a little bit and explain why it's so important to understand when you look at this massive mountain of debt that we're dealing with today? Coin Stories is proudly brought to you by Bitdeer, a global leader in disruptive technology for Bitcoin mining and AI. As a publicly traded leader, Bitdeer boasts a massive 2.5 gigawatts of electrical capacity and infrastructure under development across 3 continents, positioning Bitdeer as one of the most diversified and power-dense computing companies in the world. Bitdeer's leadership pioneered the original advancements in Bitcoin mining ASICs and is now poised to disrupt the market again with groundbreaking new designs for the next generation of mining ASICs that are targeted to reach efficiencies of as low as 5 joules per terahash by late next year. Now they're leveraging years of expertise in data center and cloud management into high-performance computing through a partnership with NVIDIA. Join Bitdeer in reshaping the world of Bitcoin mining. Learn more at bitdeer.com and explore how they are pioneering the future today.
I think that people can understand that if you spend money, for example, on a bridge, no, that is not going to generate an economic return soon, but it's going to generate multiple times the investment incurred in that bridge throughout time. No, so that is a positive for the economy and generates what is called a fiscal multiplier. However, those are very few things that actually do create a fiscal multiplier. And Frank Shostak and other economists actually talk about the fallacy of the fiscal multiplier, of the idea that you're going to spend more and that is going to generate more growth. But it's particularly concerning right now because historically in the United States, you would have a level of government deficit and a government debt that would be sort of equivalent to the level of GDP growth that was generated, so 1-to-1. However, in the last 4 years, what we see is that for every new dollar of debt, it's about 50 cents of GDP. So government debt is becoming an unproductive burden on the economy. Debt in itself is not a bad thing. It's a tool, like every tool. You can use a hammer to put a beautiful picture on the wall, and you can use a hammer to hit somebody in the head. The second is a bad tool. Well, we're using the bad tool right now. What governments are doing is using debt to disguise the inevitable reality of an entitlement spending commitment that is never going to be fulfilled. And that is in my opinion, very, very, very negative, because it's basically the only way in which the balance uh, mm, sort of gets together is by destroying the purchasing power of a currency. Yes, the
Mhm.
government will pay for those things, but they will pay it in a currency that is worth less and less and less.
Right, exactly. Currency debasement. And some of this sounds maybe complicated, but when you really drill it down, it is pretty simple. There's a difference when you're taking on debt to do something productive as opposed to
Mm.
taking on debt to pay off your debt or pay the interest expense, which is where we're
Mm.
at right now. Before I come back to the unfunded liabilities, because I want to dig into that, people recently got really excited about a hotter than expected jobs report. And when you dig into the actual data, it tells a very different story. Not only are there a lot of second jobs and part time jobs, but also the number of people employed by the government saw its biggest monthly increase ever in September. It leapt to, I think, 785,000, a new record high of 22 million workers. So, what do you think are some of the consequences of jobs shifting from the private sector to the public sector?
Well, we know it. We know how that ends up, and it doesn't end well. No, there's nothing. Again, government jobs, if they're needed and if they are something that is helpful, police, firefighters, all of the, nurses, all those things are things that may be needed. But using public debt to hire more government jobs is very negative, because obviously all those government jobs are going to be paid by the private sector. And secondly, because there is a crowding out effect. A lot of people start to think, well, it's better to get a government job. It's safe. It pays sometimes better than working in the private sector, and you work less hours. It's less demanding. No, and that's very negative for productivity. So the problem of bloating jobs figures with government jobs is is the same, actually, as, imagine if you own a company and you suddenly decide to hire um, 3 4 times more people than you need. What you end up getting is a lot less productivity, a lot less uh, improvement in activity, and it actually worsens the situation for the people that are already employed. I think that it's hugely unfair for the people who have already a government job that is required, policemen, military, you name it, um, that the government decides to bloat jobs figures with government jobs because it's making their
Mhm.
salary and their job of those people that are actually needed unsustainable. That's incredibly unfair.
I used to work in news and I would cover the public sector a lot, and sometimes I would meet local government workers. Maybe they were a county supervisor or someone that worked for a local county in California, for example, and they would be making two, three, 400, sometimes $500,000 with a nice pension. And I was like, wow, how are we affording this? And people who work really, really hard in the private sector can't make anywhere near there. But many people believe that bad policies and careless government spending, they're to blame for currency debasement. But I've heard you say that you think this is actually all intentional. So what do you
Of
mean
course.
by that? Why do you feel this way?
Well, the middle class builds from a strong economy with independent citizens that are able to save and that are able to become wealthier in time, purchase property, and obviously become independent and therefore critical with the government. However, dependent citizens are tend not to be very critical with government. They tend to have to accept whatever little money they might get from the government. So it is completely intentional to increase illegal immigration, increase government spending, and debase the currency, because you're basically making citizens like a dependent subclass that is going to need the government, no matter what color it is, in order to make ends meet. the middle class, wealthy, independent people are very critical. They don't like. They actually can stand in front of governments and say we don't like this. But if you have a citizenship in which the middle class is slowly eroding, then as a government, as politicians, you can go to those people and say, don't worry, give more of your security and give more of your independence to me, and I will solve your problems. Obviously, they won't, but you're basically creating dependent citizens.
Well, and I've sort of heard you allude to the idea that currency debasement is a tool for the nationalization of the economy. And that goes back to that idea of we're just increasing the spending on the public sector side and decreasing the productivity of the private sector. But then how do you explain the wealthy and the elite who seem to be for these types of policies and for more of a socialistic government?
Oh, that's exceedingly logical. Those are very bright people that know that socialist policies, that these policies are not tools to redistribute from the very wealthy to the poor, but from the middle class to government. So it is almost like paying a small tax relative to your wealth to eliminate competition. It's phenomenal, no? I am. This is the very wealthy, not people that have good a couple of houses or they have a good living. No, I'm talking about the really really wealthy people. Really wealthy people understand. Maybe they are not vocal about it, but they understand that those policies are not going to hurt them because they can afford those. They can afford that. If groceries are more expensive, they're going to spend. They don't even know how much they're spending on groceries. No, it's the middle class and the least well off, the ones that suffer. And obviously, currency debasement. The ultra wealthy, the really wealthy, can invest, can move their assets all over the place. Furthermore, the very very wealthy are also the very very indebted. No, so when you're basically destroying real wages, they're actually benefiting because their debt in real terms is diluting. No.
Right.
So it's I find it a lot of people say I don't understand why so and so multi-billionaire is in favor of socialist policies, and I always say, who's richer in a socialist regime than those that are close to government and the government itself? Everybody else is poor. That's why it's a nationalization process. But
Mm-hmm.
there's a few close to government that are exceedingly rich. It's basically like a tariff on progress.
Well, I find this fascinating because when I think about leadership, not just currently, but thinking back on history, I wonder: are we that quote right? Are we being put on by brilliant geniuses, or is this total incompetence? But when you talk about intentional, I mean, who is pulling the strings? There's someone behind the scenes saying this is what we should do because it will enrich ourselves at the expense of everyone else. Like, who is leading us?
No, it's not behind the scenes. It's in front of the scene, and it's not intentional, probably, but it is a policy that people accept. No, it is a policy that people live with, and because everybody, when we're making decisions or when we're making an analysis of the economy, is making an analysis of incentives versus disincentives. If you're a multi-billionaire and you complain about these things, you're going to get the media, politicians, etc., saying that you're evil, that you're antisocial, that you're a negativistic, entitled person. However, if you say, "Hey, go ahead and do it," it's paying a small price to to basically get no competition. They may not do it intentionally. They're certainly doing it and analyzing incentives versus disincentives. You see how suddenly you get an entire army against Elon Musk. No, and many may say, I don't like that. I prefer to be sort of under the radar. And how are you under the radar? Following what government says and repeating it, which is why obviously actors, multimillionaire musicians and actors prefer to pay that small tax, on top of the fact that their competition is gradually disappearing. So it's positive for them both ways, but it's because of an analysis of incentives versus disincentives that everybody does all the time.
It's time for a quick break to hear these messages from my partners who make this podcast possible. First up, Casa. It is so easy to set up your Bitcoin 3-key self-custody with Casa that I can show you pretty much the whole process in just 30 seconds. You're watching it right now. I recently switched to Casa for multi-sig collaborative custody and inheritance planning because of their enhanced non-KYC required privacy and the ease of this mobile app. Make sure to watch the tutorials and get your Casa plan for 10% off at casa.io/Natalie. Next up, Speed Lightning Wallet, one of the fastest growing Bitcoin wallets out there. Speed is a secure, low-cost way to send and receive Bitcoin and stablecoins instantly. The app is super simple to use and customers love it. Download Speed using the QR code on the screen or the link in my show notes. Use promo code CoinStories10 to get 5,000 free sats. And finally, are you ready to take control of your wealth? The Bitcoin Way is here to empower you. Learn how to take full self-custody and eliminate all counterparty risk. Set up your node and become the master of your own transactions and enjoy true autonomy. And upgrade your cybersecurity and protect your online privacy like I did. The Bitcoin Way specializes in personalized one-on-one training to help you become fully self-sovereign. Schedule a free consultation today. It's so true. Everything does come back down to incentives. Well, turning it back to currency debasement, because I think we both agree that all roads lead to that. The question I have is, how much monetary destruction can we expect to see in the future? And I know you focus on these unfunded committed liabilities, Medicare, Social Security, pensions. So first, for people who are watching that maybe they're not familiar with that term, unfunded liabilities, because when you look at the debt, we've got 37 trillion, but then unfunded liabilities were ballooning over 200 trillion, I believe. So why do you focus on that to determine how much currency debasement is actually going to happen in the future? It's baked in the cake.
So basically, two things can happen. No, when governments promise something, they're not just promising what they're paying today. They're promising what they will pay in 2, 3, 4 years time. No, 5, whatever. So we talk a lot about the current debt, but the current debt is basically just how much has the government spent over the revenues that it gets and how it finances. It's financed with higher debt, and higher debt is always in the future higher inflation, i.e. lower purchasing power of the currency, or higher taxes, or both. That's it. Mm-hmm. So, but that is the 37 trillion, which is like the tip of the iceberg. The problem is the committed unfinanced liabilities, i.e. all of those things that they will have to pay, that's called mandatory spending, that will be spent regardless of who wins the elections, that exceeds on top of that already issued debt. So committed unfinanced liabilities are gigantic in the euro area. In the case of Japan, it's phenomenal. It's about 500% of GDP. In the case of France, it's something like 400% of GDP. So when people say, hey, what have we seen in the past years? You have seen basically that in the era of no inflation, the destruction of the purchasing power of the currency has been about 40%. In the era of inflation, it's been another 20.4%, and that's only 4 years. No? So what you have in front of you, I'm sorry to say, is more currency destruction in the future. So how much is it going to be? We have seen how the US dollar has lost almost 80% of its purchasing power since the gold standard was broken. No? Well, count on another 80% because obviously it's it's accumulative, no? Mm.
Yeah. Yeah, Stanley Druckenmiller, he talked about the unfunded liabilities in a speech last year. I think he was at USC, and he talked about how the math just doesn't work. We're already spending almost 40% of all taxes on seniors, I believe. In 20 years, entitlements will cover 60% of all taxes. So the math just doesn't work out. And I wanted to ask you, how can governments implement this currency destruction when citizens are increasingly upset about high prices, because we're seeing it manifest? I mean, the more that they
Mm.
debase, now the prices, they keep going up and people are not affording them with wages not keeping up.
Well, inflation is good for a politician because imagine for a second that I am the president of a country and I'm on my way to Congress and I need to present a package of budget cuts that is going to upset a lot of people, and tax hikes as well. And on the way to Congress, I guarantee you that I will be thinking, if we had 10% inflation, because it's a hidden tax.
Mhm.
Inflation is a hidden tax. So basically, the government is taxing you, but you don't blame the government, which is great. No, and governments, in fact, they blame anything and everything on inflation except them. No, so they can say, it's the evil grocery stores. Don't
Mhm.
worry. I am going to print money to give
Yeah.
you a subsidy in order for you to defend yourself against the evil grocery stores. Or it's evil OPEC, no? These evil oil producers. I'm going to give you a subsidy in newly printed money. You see, all those measures, although inflation is the way in which government becomes the solution to the problems it creates and passes the blame to somebody else. However, as you are rightly pointing out right now, even in societies in which people are not watching your program or listening to us, it's interesting because even when governments are saying it's corporations, it's grocery stores, it's evil landlords, it's OPEC. People actually sort of make an analysis and say, no, it's you. So they do blame governments for inflation. That's why you need more dependent people so that they don't throw you out of your job uh, uh, because they see that because they're still independent, middle class, wealthy people, and they can kick you out of power. It is a policy. Inflation is a policy.
A very destructive one that most people don't realize is right there in the form of asset inflation. They can't afford anything. But hey, I think you've written that first they really need to silence the people, right? Then they eliminate your options to really run away from the currency, and then they sort of enforce this expropriation with the motto that, oh, you'll have nothing but you'll be happy, right? Is
Exactly.
that's sort of
That
the
is it. No?
operating.
Yeah, absolutely. Think about this. Why would a government that is going to defend the purchasing power of the currency and do everything to keep your wealth higher, be have any incentive or any intention to reduce your freedom of expression? No, because it wouldn't matter if there was some crazy Daniel or some crazy somebody else out there saying, "Oh, the government." The vast majority of citizens would say, "Hey, I'm pretty well off," which has happened in the past. No, very, very, quite a distant one. But but when it has become so evident that governments will not be able to pay for those unfunded commitments
Mhm.
with a strong currency, then what they need to do is one, silence people, two, impose that the only option is the currency that they issue. Because if you can move somewhere else, that is not a good thing for for a lot of governments. No, so it's and let me explain why, because governments don't do this trying to make people suffer. They do this thinking that the economy gets its wealth from government spending and
Mhm.
from government debt. So the politician actually starts to repress people and to impose a currency and goes from welfare to destruction, thinking that they are doing the best for people. That
Mhm.
I guarantee you that they will think, oh, the reason why inflation is rising is not because of me printing, it's
Right.
because what I print is not demanded.
Right. And this is why ultimately politicians are just getting richer and richer and richer, and they can afford $50 million homes in Lake Tahoe while everyone else is getting poorer faster and faster. Let's shift and talk about Bitcoin for a moment. I have some specific questions, but first, let's just zoom out. What is your take on Bitcoin? Because I feel like you're not totally down the rabbit hole maximalist, selling everything for Bitcoin, but you're also you do think that it's an emerging asset class, right?
Absolutely. I think that what's most important about Bitcoin is is like when you see a child grow and become stronger and more mature. No, there's a pride there, and obviously I haven't created it. But what I like about Bitcoin is that it's gradually becoming money. No, in order to become money, you have to be a reserve of value, a unit of measure, and a uh, uh, a means of payment of generalized use. I think that what's important about Bitcoin is two things. Number one is that it has separated itself as a class of its own. I think that that is what's most important actually today about it. There's a book behind me called A Choice in Currency by Frederick von Hayek that he published before the internet and obviously Bitcoin existed, in which he shows that the arrival of independent currencies is going to be was going to be a burst of different options to try to combat inflation and the destruction of purchasing power from governments. No, but he also warns that in order to become money, they need to become generalized means of payment. So the vast majority of those independent currencies would actually disappear, and then there would be one, maybe two, maybe three that would thrive. Bitcoin is actually in that process of becoming an
Mhm.
asset class in itself that has its own liquidity, which is a good thing. When markets correct, it doesn't decline 80%, something like that, as it did prior. So it's sort of, let's say, growing independently to be money. It will never be an alternative to the US dollar, obviously, because it doesn't have the liquidity to do it. But it's sort of becoming a real alternative for its own purposes in its own universe. No.
Well, I believe you said in late 2023 that it was really unlikely that central banks would cut rates aggressively if unless we were in a crisis. And you were curious to see how Bitcoin would perform in an environment of monetary contraction. So here we are.
Mm.
Central banks, though, are back at it. Global M2 is expanding. Bitcoin and gold have been benefiting from that. And I guess my question is, are you surprised by what you've seen from the Fed and other central banks over the past couple of months? And has it changed your view of Bitcoin at all?
Well, no, I'm not. I was surprised because obviously, if the Federal Reserve, which is the highest monetary authority and is supposed to be the most independent one, says we're going to be in a higher for longer environment, and higher for longer lasted less than 18 months, my God, huh? Then obviously it was a surprise, no? But a number of things that have surprised me about Bitcoin in the period of so-called monetary contraction is that it's held very well its support levels, which goes back to the point that I was mentioning before, that it's becoming an asset on its
Mhm.
own, no, and that in the most aggressive period, its decline in price was not as severe, for example, as some technology equities that used to have a one-to-one correlation, almost one-to-one correlation with Bitcoin. No? So I think that it's sort of developing a flaw that both current investors and those that look at it from the perspective of what is the exchange rate relative to the US dollar look at. Obviously, another thing that not surprised me, but that I found quite interesting was how Bitcoin has become a true reserve of value. We always talk about Bitcoin in US dollars. Talk about it in Argentine pesos or in Iranian currency or in Turkish currency. So the important thing is that it's actually sort of developing into a class of its own that
Mhm.
gives that kind of reserve of value for many people that suffer uh, the worst environment in terms of inflationary policies.
Yeah. So what I hear you saying is you think that Bitcoin's sort of in that emerging phase. It has separated itself from the other cryptocurrencies. It's slowly moving into becoming money, but it still has a ways to go. And one thing I do want to question you more on is that correlation. You've talked about how Bitcoin continues to be maybe too correlated with tech. And I think that that's fluctuated over the last decade. I
Yeah.
believe the 90-day rolling correlation to the Nasdaq and S&P 500, it's gotten as high as 60, which is pretty moderate, but it's also hovered around zero, so no correlation for some years. So
Yeah.
I think that there have been times when gold is more correlated to stocks than Bitcoin. So what's your take on that?
Usually, it happens in periods when markets are discounting real negative interest rates or real positive interest rates. I think that's what makes the difference. No, but it is true that what it is showing, what you're saying, is that its its volatility is more intrinsic and less related to whatever is going on the fiat currency the monetary world. Yeah, it has more to do with that pure negative interest rates. Obviously, real interest rates, negative real interest rates, will certainly make Bitcoin move faster in relative terms than tech companies. While tech companies tend to work better, or at least tend to move faster with money growth. No, so it's rates versus supply of money. What probably makes that disconnection that you just mentioned.
Well, and I know that Bitcoin has largely been correlated with just global liquidity, and people have been talking about that more. Global liquidity measures going up, M2 is expanding, and gold and Bitcoin again sniffing this out. So, given what we've discussed today, I'm getting the sense that you are on the nothing stops this train bandwagon, that the governments will have no choice but to continue to debase the currencies. And that ultimately means that Bitcoin up, gold up, maybe everything up.
Everything up, everything up. This is going to be a question of your tolerance of volatility. But ultimately, it's not that everything is up, is that one thing,
Mhm.
the currency in which we measure it, is going down. No?
Yeah.
So longer duration assets like tech, like Bitcoin, like the thing, startup currencies, slightly or significantly higher, no, because they basically are ultimately a net present value discount of how much of this monetary destruction that we were mentioning is going to happen in the future. The higher, the better. No? So um, so it does it. That's why what I say is all the time to people, okay, we're talking about monetary destruction, we're talking about currency debasement, we're talking about government spending, debt, etc., etc. Protect yourself. Protect yourself. You can protect yourself. You cannot protect yourself if you're holding treasuries and you're holding cash. Those two are the one. Treasuries are money, so there's no way in which the government that is actively looking to dilute its financial commitments is going to pay you real returns on
Right.
that money. No, so protect yourself. And if you, some people cannot tolerate the volatility of Bitcoin. They say, those are the kind of investors that when they look at the S&P 500 go down 200 basics, 200 points, they go crazy. Okay, fair enough. It's about your tolerance of volatility, not the need to invest in those assets that will give you that kind of protection against currency
Mhm.
debasement.
Well, what about you? Let's talk a little bit about your take. Do you personally invest in Bitcoin and share how much you allocate based on your own risk tolerance? And
Hmm.
given the fact that they're going to have to print and Bitcoin will probably benefit, isn't it almost the best asymmetric bet on the fact that they're going to debase the currency?
The best asymmetric bet, volatility adjusted, tends to be gold because it has a history of being money. No, there is no doubt that if tomorrow there is a global crisis and you have some gold, physical gold, you're going to purchase food and shelter. Hmm? Everything else debatable. No, so I think that, so first, yes, I invest in Bitcoin, and I invest in equities and in gold, but my allocation, probably boring old person that is closer to retirement, obviously tolerance for volatility, you know, moves with age, and that's logical.
Mhm.
No, we're about capital preservation more,
Yeah.
no, but more on the capital preservation side, it's an allocation of about 5 to 7%.
Okay. Well, that's bullish. It's not, I thought maybe you might say 2%. So,
No,
um,
because ultimately, at the end of the day, uh, the reason why this may have changed, and if you allow me to expand on it, why, is
mhm,
because um, my view of what is going to happen in terms of monetary debasement now basically makes it almost wasted capital or empty calories to put money in sovereign debt.
right.
Historically, you would say, hey, 60% bonds or 40% bonds, 60% equity, whatever.
Yeah.
Now, zero bonds, or at least
Wow.
sovereign bonds.
Well, the governments can't have that, right? That's what I wonder what's going to happen in
I'm
the
already
future with
financing them.
it.
So the thing is, ultimately, when you understand that sovereign debt is money, yeah, is that
Mhm.
I'm already, why should I pay taxes and on top of it pay with my
Right,
investment for a return that is going to be below inflation
right,
uh, as much as they can? Financial repression is not going to end.
right. And a lot of people don't actually talk about the rate of monetary inflation, like how much they're actually expanding the supply. And from the data that I've looked at, it's anywhere between 7 to 10% annualized. Is that what you've seen? So basically
Mhm.
you have to maybe get 12% returns.
You would have to uh, basically what we could consider uh, a rate of money growth that is acceptable for, let's say, no recession environment, it would be around the 3.5%. So we're double that, no?
Yeah,
Considering all liquidity measures. A lot of
right,
people only talk about M2. That is
right.
incorrect. You need to consider, broad money. So at
Mhm.
7%, you basically, in order to reduce your exposure to monetary destruction, you basically need to aim for about 10%, knowing that if you aim for
Yeah,
10% and the lowest risk asset is giving you, or the so called lowest risk asset is giving you 4%, then the volatility that you're going to
yeah,
incur is higher and the risk is higher, and there will be minus 10% years, obviously.
yeah. Yeah, I no longer see sovereign debt as the risk-free asset because now it has the duration risk with all the inflation. It's going to be worth nothing, and then it has increasing default
Yeah.
risks. I think. Well, we've covered a lot of ground. This has been really fascinating. Anything else that you want to share or touch on that we haven't?
I think it's important for everybody to understand their own investor profile and their risk profile in order to decide where do you feel more comfortable, because ultimately it's all about your your what level of risk is going to make you sleep at night and what will not make you sleep at night. No, I know people that say, I don't care if Bitcoin falls 50% because I'm not even looking at the screen, and some people, and probably rightly so, don't even look at it relative to US dollar. No, phenomenal.
Mhm.
And other people will say, go crazy. No, so what I would say is simply is understand well your risk profile in order to decide the capital allocation. It doesn't mean what I do or what somebody else does. Obviously, at 57 years old, I'm more about capital preservation than adding to wealth.
Well, it's good advice. Sometimes people laugh at me when I say that I'm risk averse. That's why I
Yeah,
love Bitcoin so much,
yeah. Good
because I
point.
see it as very
Great point.
conservative. Well, Daniel, it's been so great to have you on the show. I'm going to put links to your work below in the show notes. Thank you so much for joining me. I hope to get the chance to talk to you again soon.
It's been an absolute pleasure. I thoroughly enjoyed it. Thank you very much.
Thank you so much for checking out this episode of Coin Stories. This show is for entertainment and educational purposes only. Nothing should constitute as official investment advice, and you should always do your own research. My inbox is open. If you want to share feedback or guest suggestions, just reach out at natalie@talkingbitcoin.com. Make sure you're subscribed to the show and check out my free newsletter, nataliebrunel.substack.com. I'll see you next time.